A single car renting for $60 a day at 70% utilization brings in roughly $15,300 a year in gross revenue. That number sounds solid on its own. It only tells half the story because that same car is also losing 10 to 20% of its value every single year, whether it's parked in your lot or out on the road being rented right now. Open a car rental business and you're not just renting out vehicles. You're racing a depreciation clock that never stops on an asset that only earns money on the days it's actually booked. Drop utilization even modestly below the range successful operators maintain, and the math flips from a business that earns a real margin to one that's quietly losing value on every car sitting idle, no matter how healthy the day rate looks on paper. At its core, a car rental business is two things happening at once: a service business renting daily access to a vehicle, and an asset management business holding a fleet of rapidly depreciating equipment that has to earn its keep before it loses too much value to be worth owning. Those two identities pull in different directions. The service side wants cars out on the road as often as possible, generating rental income. The asset side is quietly losing 10 to 20% of each vehicle's value every year, regardless of how often it's rented, with premium and luxury vehicles typically depreciating even faster than economy models. A car sitting in the lot isn't neutral. It's actively losing value while earning nothing to offset that loss. This is also increasingly an industry with two genuinely different business models sitting under one label. The traditional model means owning or leasing your own fleet outright. A newer asset-light marketplace model instead connects private car owners with renters, collecting a commission without ever owning a single vehicle, trading a much lower financial risk for a business that depends entirely on attracting enough car owners and renters to make the marketplace work at all. The range here is genuinely enormous, and almost entirely driven by whether you're buying vehicles or building a platform to connect other people's. A small-owned fleet, 5 vehicles, a realistic mix of economy and mid-range cars, commonly requires $70,000 to $120,000 just to acquire the vehicles themselves, with individual vehicle acquisition costs ranging from around $22,000 for economy models up towards $60,000 or more for premium ones. A marketplace-style platform, connecting car owners directly with renters rather than owning inventory, can launch for a dramatically smaller $2,000 to $25,000, since there's no fleet purchase sitting at the center of the startup budget at all. Most new operators building a traditional fleet lean heavily toward leasing, rather than buying outright in the early years, commonly keeping 60 to 70% of the fleet leased specifically to conserve capital and limit exposure while the business proves itself, before gradually shifting toward more ownership as utilization and cash flow stabilize. Here's the part that catches almost every first-time fleet owner off guard. The vehicle purchase price is just the entry point. Insurance alone for a properly covered fleet runs $3,000 to $5,000 per vehicle per year for commercial auto coverage, plus additional general liability and umbrella coverage on top. A genuinely significant recurring cost that scales directly with fleet size, regardless of how many of those vehicles are actually generating revenue in a given month. Buying the cars and getting insured is the straightforward part. Here's what actually makes running this business harder than the day rate math suggests. Depreciation doesn't pause for an empty lot. A vehicle sitting unrented for a week hasn't just missed out on rental income. It's also lost real value during that same week. An ongoing cost that keeps running whether the car earns a dollar or not, which is exactly why utilization matters so much more here than in most other rental businesses. Fleet composition is a genuine balancing act. Economy vehicles drive volume and steady utilization, but carry thinner margins per rental. Premium and luxury vehicles generate meaningfully better margins per booking, but require significantly more capital upfront and depreciate faster, meaning a fleet weighted too heavily toward either extreme carries its own distinct risk. Replacement timing is a real, recurring capital decision, not a one-time purchase. Successful operators typically cycle economy vehicles out after 2 to 3 years, and premium vehicles after just 18 to 24 months, specifically to limit depreciation losses. Which means the fleet acquisition cost from your opening month isn't a one-time expense. It's a recurring capital commitment built into the business permanently. Full commercial-grade insurance is mandatory, not optional. A standard personal auto policy simply doesn't cover vehicles used for commercial rental, and operating without the right commercial coverage isn't a cost-saving shortcut. It's a genuine liability exposure that can end the business in a single bad incident. Assume the fleet is acquired, insured, and out on the road generating bookings. Here's what it costs every month just to keep the operation running. For a modest 10-vehicle operation, monthly costs before vehicle financing commonly total $7,000 to $16,000, covering insurance, facility rent for parking and operations, ongoing maintenance and repairs, booking software, marketing, and basic utilities. Add vehicle loan or lease payments on top of that range, and the true monthly fixed cost of running even a modest fleet becomes a genuinely significant, non-negotiable number that has to be covered before a single dollar of profit exists. And this is the part that quietly separates operators who thrive from ones who struggle. Because depreciation and fixed costs run continuously regardless of bookings, the entire business lives or dies on utilization rate. The share of your fleet actually out-earning revenue on any given day, far more than it depends on the headline day rate advertised on the website. Here's the calculation that decides everything else in this business, and it's simpler and more brutal than most first-time operators expect. Take that $60 a day car at 70% utilization, generating roughly $15,300 a year. Now hold the day rate steady, but drop utilization down toward 45 to 50%, a swing that happens constantly with seasonal demand, a slow local market, or simply too many cars added to the fleet too quickly. Annual revenue from that same vehicle falls proportionally, but depreciation doesn't fall with it. That car is still losing roughly the same 10 to 20% of its value over the year, regardless of how many days it actually sat rented. Below a certain utilization threshold, commonly somewhere in the 65 to 80% range that successful operators maintain, a vehicle's rental income stops comfortably covering its own depreciation and fixed costs, and every additional idle day pushes that specific car closer to a net loss for the year, even while it's technically still generating some rental revenue. Utilization isn't just a performance metric in this business. It's the line between a fleet that's earning its keep and one that's quietly bleeding value one idle day at a time. The fleet owner buys or leases vehicles directly, controls the entire customer experience, and captures the full day rate on every booking. This owner carries real depreciation risk and significant upfront capital exposure, but keeps full margin control and isn't dependent on a third-party platform's commission structure or policies. The marketplace operator builds or operates a platform connecting private car owners with renters, collecting a commission without ever owning fleet inventory. This owner avoids depreciation risk almost entirely and launches with dramatically less capital, but depends completely on network effects, enough car owners and enough renters showing up at the same time, and earns a smaller share of each transaction in exchange for carrying none of the asset risk. Picture two small operators, both launching a 5-vehicle fleet with $100,000 in acquisition capital, same city, same general vehicle mix. First operator prices competitively to win bookings quickly, but doesn't actively manage which vehicles get prioritized for rental or track utilization closely by vehicle. Average fleet utilization settles around 52% over the first year, below the healthy range successful operators maintain. Gross rental revenue looks respectable, but once real depreciation across the fleet is properly accounted for alongside fixed costs, net margin for the year comes out barely positive, with 2 of the 5 vehicles effectively losing money once their individual depreciation is weighed against how rarely they were actually booked. The second launches with the same fleet and capital, but actively tracks utilization per vehicle, adjusts pricing and marketing to keep the whole fleet consistently booked, and cycles out underperforming vehicles faster rather than letting them sit. Average utilization holds around 74%, comfortably inside the healthy range. Gross revenue looks similar to operator ones on paper, but because depreciation is being earned back consistently across nearly the entire fleet instead of just part of it, net margin lands meaningfully higher, comfortably inside the 8 to 25% range well-run operations report. Same starting capital, same fleet size, same market. The entire difference came down to whether utilization was actively managed or simply hoped for. A car rental business isn't really measured by its day rate. It's measured by how consistently the fleet stays out on the road, because every vehicle is quietly losing value, whether it's earning rental income or not. And the gap between a profitable operator and a struggling one usually comes down to a utilization percentage. Most first-time owners never learn to track closely enough. Whether you're financing your own fleet or running an asset-light marketplace connecting other people's cars, the underlying bet is identical: that you can keep vehicles earning consistently enough to outrun the depreciation clock running quietly underneath every single one of them, whether they're booked or sitting idle in the lot. Get utilization right, and this remains a genuinely scalable, recurring revenue business. Get it wrong, and a fleet that looks busy on the surface can be quietly losing more value than it's earning, one idle day at a time.